Right, good morning everyone. Let me start with showing the resources for this course, okay? Because I kept getting email, people send me email at the 11th hour like, oh, I can't see assignment. I have no idea how I can find things in this course. Okay, I have repeatedly communicated that information. So first of all, let me start with the syllabus. So if you go to the syllabus here, I have organized the course by modules. Okay, so currently we are in the cost of capital modules, and then that I also have given the time frame. So from September 14th to September 20, we're going to be covering this modules 3, the cost of capital. And this assignment is due at 9:20, which is September 20 at midnight. So this is the one place, you can see the assignment, but it's a lot more easier if you go to Canvas, okay? So when you go to your course, so first of all, you log into Canvas, and then you go to your course, which is, you just click on the course. And once you click on the course, you will see what is the upcoming assignments. It's right here. It's to-do list. If you check your to-do list, you'll see what is coming up. So as soon as you log into Canvas, you can see what is the upcoming assignments. This is the easiest way to find out the assignments. Well, this will not show your MindTap assignments, so I have put even clearly over here. So currently we are in modules 3, so I'm going to click on modules. You can go from the home page, or you can go to modules over here, and then I'm going to come to week 3. So this is the week 3 we are right now covering. Okay, so as I mentioned earlier, the resources and activities tab is the most important one. So you have everything over here. So if you scroll down, at least I want you to go through these resources, and I have a complete lecture video on cost of capital. You don't even need this Zoom session for this topic, cost of capital, because I have a comprehensive notes followed with the videos. So you can easily go over the notes, and if you find difficulties in solving weighted average cost of capital or cost of equity, cost of debt, or anything, you can find out the solution for that. Okay, so I have here, it's a comprehensive video on how to calculate weighted average cost of capital. I made this problem covering everything. Okay, so you can imagine you are calculating cost of equity, you are calculating cost of debt, you are calculating cost of preferred equity, and you are calculating all the weights, and then you are finding the average cost of capital, which is the cost of capital. That's the whole thing in this chapter, in this module. Cost of capital is covered on this video. So how to calculate weighted average cost of capital. That video does everything you need to know. Calculating cost of debt, before after tax cost of debt, cost of equity using couple of approaches, and then cost of preferred stock. Calculate all the weights you need to use for the WACC calculation, and finally I calculate the WACC, or weighted average cost of capital, using all the inputs I calculated in this example. So this video itself covers every single thing. When you go to MindTap, there are a lot of walkthrough. So how to calculate cost of preferred stock, how to calculate cost of equity using a dividend discount model, how to calculate cost of equity using CAPM approach. All these walkthrough in MindTap, they make our life so easy, because there is a walkthrough on each of these type of problems. So down here are assignments here. So here, this is the thing you need to look. What is due in this module? Okay, I'm not going to go by the week. What you are expected in terms of grading you are expected to do on this assignment. Not only this one, I go ahead and then also summarize the whole modules over here in the checklist. Okay, you just click on the checklist. I mean, check the introduction, check the resources and activity, homework, and anything else. These are the 2 assignments, and these are the resources for you. So everything is listed, everything is organized such a way like anybody can follow through. Finally, you can go to your modules, you log into your MindTap course. All right, so here is the complete course in MindTap. Okay, so if you expand this one, here, you'll see everything. Okay, well, this is too much. You want to see by the module, so what you can do is you can click on module 3 and then again click on expand this one. Then here I tell, okay, what is the most you have to do. So all these resources I listed, and at the end I said graded assignments. Okay, and you click on that, and what is graded, so there is no confusion. It's designed such a way like anybody can follow. So please check your resources. This is not an on-ground class at the moment. In on-ground class, I come to class, I solve problem, I help everything. Okay, but in online class environment, right now we are doing online, and you have everything you need to know to be successful in this course. So I have designed everything such a way like they're going to be very helpful to you. So this is about finding resources. I hope this short intro will help you to navigate through the course resources. Okay, any question? All right, then if you have no questions, then let me start talking about the cost of capital. Okay, so all right, let's become a little bit interactive. Okay, let me ask you a question. What do you mean by cost of capital? Anybody can give some feedback on that, give some response. What do you mean by cost of capital? Let's break down on the topic, okay, and then it's going to be a lot more easier and clear. So what is the cost of capital? Can you see this screen like Word document, blank one? Yeah.
Cost of capital is how much it costs for
Okay, so can you explain in terms of your personal life? So what is capital and what is cost? Okay. Okay, Dylan? Yeah, you can give any example. Okay, no problem. Actually, she had really good point. We can even break down capitals like this is actually it's a money and human capital. Okay, we can break down capital in 2 different terms. It's a the capital is simply money. Okay, it's a money. Okay, and cost is basically a company, or we pay company interest or returns. Let's put this way. A company pays So cost is simply the interest or rate of return a company pays to investor. Capital is just the money. So if you talk about your personal life, you borrow money from the bank to buy a car, right? That's a capital. So the money you borrow from the bank, that's a capital. And then the interest rate you pay to the bank is the cost. Okay. So cost of capital is simply the rate of return or the interest rate a company is going to be paying to its investors. So the sources of capital. There are two broad categories of capital. Okay, so the first one is equity, and then the second one is debt. Are you clear about that? So a company can generate capital from different sources. The first one, they can issue the shares. Issue shares, right? The second one, they can issue bond. So we already cover equity valuation, debt valuation, right? So using the information we learned in equity valuation and debt valuation, we can calculate cost of capital for the whole company, because earlier we calculated cost of debt, which is for individual security, and we calculate cost of equity for individual company, right? Now we can combine both of them and find the average cost of capital. That is what we call weighted average cost of capital. Okay, so in equity we have two types. This is common equity, and then we have number two is preferred stocks, right? So we have two types of equity, common equity and the preferred equity. Okay, but not all companies they use both of them. But in our weighted average cost of capital calculation, I'm going to include all of them. Okay, so this is the cost of capital. In this context, I'm going to call, so this is also called the weightage WACC, WACC. Okay, all right. So going forward, I'm going to use the term WACC, WACC. In other words, WACC is the cost of capital, which combines all sources of capital and calculates the average. So if you are calculating the WACC for any company, that is going to be, we're going to start with the first component. I can start with debt or I can start with equity. So let me start with cost of debt. Okay, cost of debt plus cost of equity. Okay, so this one I'm going to include percentage cost of debt. Okay, or in other words, it's a weighted average. Okay, it's a cost of debt, the weighted cost of debt, and the cost of equity. So basically, cost of debt in our bond valuation chapter, we did YTM, right? You remember YTM calculation? using the 5 keys we estimate rate, right? That's the cost of debt. So here I'm gonna call that term is R sub D. Okay, the same terms I'm gonna call R is return, D means debt, return on debt. A return on debt for a person, investor, is cost for the company, right? If the cost of debt is, if my required rate of return on a debt instrument is 10%, for example, then a company has to pay me 10% to encourage me to buy the debt from Citibank, right? So cost of debt for each company is different. So R sub D, cost of debt is R sub D. Cost of equity, that is R sub S or R sub E. You can call whatever you want. R sub S is return on stock. R sub E is return on equity. Whatever name you want to give. And in stock valuation, we did couple of approaches to calculate them. So what are those approaches? We used dividend discount model, right? If you remember, we use constant growth model, and in constant growth model we have R sub S that equals to, so basically let me start with this one, T0 equals to D1, so D1 divided by so D1 divided by R minus G, right? Do you remember? We had that. So this is the thing we use. In dividend discount model, we calculate the price of the stock using the dividend and the growth information. So if you manipulate this equation, actually we can do, so we get this. If you change this, if you solve this equation for rate, which is this one is R sub S, okay, I'm gonna put this one is R sub S. Okay, so if you want to solve for R sub S, what happens is R sub S equals to D1 you divide by P0 plus the growth rate. So plus the growth rate. So this is what is going to be the cost of equity if you are using this approach. All right. If you are using this dividend discount model, in your BA 360, you also learned that cost of capital can be calculated using CAPM. So we can use CAPM and calculate R sub S, that equals to expiry rate plus beta times RM minus RF. So we learned that too. So we can calculate cost of equity using different approaches. Okay. Well, we can also have two different types of equity. Okay. So we can have, so equity we have like common equity, and right? So we have A, common equity, and we have B, preferred equity, right? So if we summarize all of this information, okay, we can come up with a pretty nice formula for weighted average cost of capital. When you combine cost of capital, cost of debt, again, cost of capital refers to the rate of return or the interest a company has to pay to its investor. I'm putting in returns because returns goes for equity and interest goes for the bond. Okay, so cost of capital, now you know that there are two sources of capital. When you combine them together, we're gonna call WACC, the weighted average cost of capital. So, and we're gonna consider the cost of capital after tax. Okay, therefore I'm gonna summarize the WACC. Let me go down here. I'm gonna summarize the cost of capital this way, right here. WACC, that equals to, okay, all right, that equals to, we have the percentage debt times R sub D, okay, R sub D. Everybody clear what is R sub D means? Cost of debt times, okay, times 1 minus the tax rate. 1 minus tax rate, okay. This is the weighted cost of debt, okay. This is, in other, let me put this one up. So this is after tax cost of debt. So you have YTM, yield to maturity, you multiply by 1 minus the tax rate, you're gonna get after tax cost of debt. Okay, so now WACC equals to percentage debt times R sub D times 1 minus the tax rate. Okay, 1 minus the tax rate. If you want to put this multiplication sign over here, that's fine, but the parenthesis itself refers to the multiplication, right? So this is the first component, okay. And you remember, now we're gonna add the cost of equity, okay. So in equity we have two parts. So we have cost of preferred stock, so percentage, I'm gonna call this preferred stock is PS, okay. PS refers to the preferred stocks, okay. Percentage PS, let me put percentage of preferred stock, you multiply by R's of preferred stocks, okay. R's of preferred stock is cost of preferred stock, plus finally percentage of common equity times R sub E or S, whatever you want to call. Okay. In other words, WACC. Now let me put this one the weight. Okay. So percentage means this is the W. Okay, W. I'm going to call WD. Right? What is WD means? Weight of debt. That means it's percentage of debt you are using on your company. Your company is comprised of two different sources of capital. You have debt and you have equity. In equity, you could have preferred stock and common stock. Not all companies, they have preferred stock. Okay, so I'm going to call WD, which is weighted percentage debt, times RD, which is cost of debt, times 1 minus tax rate. Okay, this is the first part. The second part, if your company has preferred stock, I'm going to call WPS, weight for the preferred stock, times now cost of preferred stock. Oh, let me put here preferred stock. All right. And finally, we're going to have plus weight of RS, okay, weight of stocks, common stock, okay, times Rs of S. So this is the formula for the cost of capital. This is the whole thing. I showed you, so in resources and activities, calculate weighted average cost of capital. There is a video that calculates all of these components and help you understand what is cost of capital, how you calculate it. Well, still I'm going to do it. So notation, WACC equals weighted average cost of capital. Okay, so what is the second term? WD. That is actually percentage debt or weight of debt. Okay, R sub D is cost of debt. WPS is percentage which is weight of preferred stocks. RPS on preferred stocks, return on preferred stock. Now WS is percentage equity or weight of common equity. And finally, we have R sub S or E, that equals to return on common stocks. Okay, so these are the notation for the WACC formula. Okay, so this is the formula we're going to be using in this chapter. And when you are doing homework problems, you know, we have multiple different, sometimes you have to calculate just the cost of debt, sometimes you have to calculate just cost of common stocks, sometimes you have to, I mean, you know, all these breakdowns are available over there. So this is actually the formula to calculate cost of capital. Capital is the money a company borrow from issuing debt, which is a bond, or issuing stocks. Okay, company can issue stocks or company can issue bond. So when they issue bond, as you know that they have to pay coupon payment and yield to maturity, right? So the cost for the bond is, total cost for the bond is yield to maturity, which is R sub D. Okay, and cost of common stock is basically, it's a required rate of return and investors needs to buy the stock of a company. Therefore, you can see price of the company's stocks are different because the cost of equity and the growth expectation is different. All right, any question? Let's do some discussion. Did you understand the topic clearly? Yeah. Is it about the homework or problems or this? Just let's finish this conceptual. Okay. Yeah. Any other questions? Is this concept clear? Capital is just the money. Okay. Simple language. What is capital in our case? I mean, you can have fixed capital, right? And liquid capital. So in this case, I mean, if you have fixed capital, still you borrow money to buy them or use your equity, right? So, but in this chapter, when you think about cost of capital, we refer to the money a company uses. Okay, and that money they have to borrow from some sources, and when they borrow money, they can borrow money issuing debt, or they can get the money by issuing the equity, right? For both of these investors, they have to pay rate of return or the interest. That is called cost of capital. And when we combine them, both of them, based on the percentage the company use those resources, we call that weighted average cost of capital. Clear? Okay.
So that means like if interest rates are generally low, companies are willing to take on more debt in the form of bonds because the interest
Well, that's a very good question. That's what is happening right now. I mean, in general, that's what happens when the interest rate is so low right now, close to zero, right? So if the overall interest rate in the market is low, because this R sub D is determined by many different components. If you look on the chapter, this one is the function of so many things like the inflation rate, the federal interest, the fund rate, the default rate, and so many other things, right? So usually the federal fund rate is the big component, like that's the market interest rate, right? If the market interest rate is low, then basically the cost of debt is going to be lower. That's the reason it's going to cost them very little to borrow money using debt. Therefore, they keep issuing more debt. That's a good question. Sure. Let me see. Who has questions? Nobody? All right. Sure.
Remind me what T equals, is that time?
Oh, thank you. I actually forgot to write that. It's a T equals to tax rate. The tax, corporate tax rate. So whatever percentage, because when they issue bond, they actually have to pay interest, and that interest is tax deductible, right? So we're going to consider after tax cost of debt. This is after tax cost of debt. Let me put that too. So if you take out the, so if you adjust with the tax rate, so 1 minus tax rate, let's say if your tax rate is 25%, so basically you are paying only 75% of the debt, right? So RD times 1 minus tax rate, that's going to bring down your actual cost of capital, cost of debt after tax. Good question. All right, then let me do one problem, okay? And then I'm going to start, because, as I mentioned earlier, let me share you one more time. Let me save this one first. Let me share you this. Canvas site. And then we're going to go to modules 3. And I highly recommend everyone, please watch this video, the weighted average cost of capital calculation. I have calculated everything, the weights, the cost of equity, cost of preferred stock, cost of common stock, cost of debt, YTM, you name it, everything over here. Okay, and I write a problem and I solve each of them one by one, so you don't have to skip a part. I have taken time, I have explained everything and calculated this one, so please check this one out. Okay, how to calculate weighted average cost of capital, that has everything, so please check that out. All right, so now let me share this Word file again and then simply create a problem so we can solve together. All right, I'm going to write an example and then I'm going to break down. Okay, example. Maybe I'm going to put this one down a little bit. All right, example. So in this case, I'm going to just simply write a plain example, 30%. Oh, it's lower, right? The tax rate is 19%. 19%. What is the weighted average cost of capital? All right. Everybody clear about this question? Okay, so basically I could have given the dollar amount over here. Okay, I could have given the dollar amount over here. Does that make sense? But I gave the percentage. What if, let's say this question could be rewritten. Okay, the weights are given here. In the second example, we need to calculate the weights. So we need to calculate the weights using the debt, preferred stocks, and stocks in the balance sheet. Okay, so or given in the problem. So to calculate this weighted average cost of capital, what we need to do? Here simply we can plug in the number. Okay, here simply we can plug in the number. In this second example, we need to calculate the weights first. So which one do you want me to do? It is a lot easier than what you think. Okay, this one is, I think, one of the easiest chapter in my opinion. And I gave you the balance sheet, right? I gave you the balance sheet. Sometimes you have to use the market information. Debt is trading in the market, equity is trading in the market. So based on that, that's the only simple difference is whether you are using the book value or the actual market value. What is the difference between book value and market value? Book value is in the balance sheet. The market value is the price is traded in the market, the share, the stock price, the bond price. So whether you are using, I think you have one homework problem, you're going to be using market information, which is using the market information, market versus using the bond, the historical information, which is the book value. So book value versus market value. So for example, I give you example. Book value of this company. Example. Okay, we have debt plus preferred stock plus common stock. Okay, so equal. We have in the second example we put 40 million plus 10 million plus 50 million, which is equal to 100 million. This is actually is so this is the book information. Okay, so actually if you see the net, so this is the book, these are the book values of the capitals, okay, not the book value of the company. These are the book values of these sources of capital. If the problem gives you, let's say there are 5 million shares outstanding and the stock is trading for $10 or $20, right? What happens if the stock is trading for $20? So the value could be more than or less than this 50 million, right? So when you use the market information of any of these security, that we call market value. That's the difference between book value versus market value. So if you clearly understand this concept and these questions, then I can use Excel, because I like to use Excel so that, you know, I can summarize easy. I can just plug those numbers and find a solution easy. Which one do you want? Do you want me to use Excel? Can you clearly see this Excel file? Okay, and I'm gonna call this one is cost of WACC calculation. Okay, all right, let me bring the question. Let me bring this one here, and I'm gonna solve both actually for you. So it's just its average cost of capital. So I'm gonna summarize this problem. Okay, because I know that this WACC equals to WD times RD times 1 minus tax rate plus WPS times RPS plus WS times WRS. I know this formula, right? So this is what you're going to calculate. You're going to calculate the WACC, weighted average cost of capital. Okay, right here. So I'm going to start with the formula and I'm going to put all this notation. So WD, okay, can you please tell me what is WD in this question? Yeah, so what is the weight of the debt in this example? Thank you, 40%. Yeah, please tell me whenever I write these numbers, okay? So let me put nicely 40% and Let me take them down. All right. All right. So what is the second thing we are doing? RD, right? What is our RD? 7%. Okay, thank you. And then what next in the formula? The tax rate, right? What is the tax rate? 19%. And what else in the formula? WPS, right? So WPS, how much is that? 10%. And then RPS, which is cost of preferred stock, how much is that? 8%. And then finally, we are coming to the equity. Let me put a little bit smaller font so that we can see. All right, so WS equals to how much? 50%. And finally, R's of S equals to R's of S. How much? Thank you, 12%. All right. So we put all these things, we summarize every single thing here, right? So if you see this is coming too much down, I can even just go ahead and put this one in next column here. Okay, I can do that, right? So these are the things we summarize from the above question. Okay, so let me copy this formula and plug these numbers. Let's what happened here. Oh, that's nobody remind me. There is an error over here. This is actually RS. Okay, this is RS. So let me bring this formula down here. If you use Excel, this is how much easy it's going to be. Okay. All right. Just to show you, I'm going to use these 3 different blocks to calculate each of them. Okay. So I'm going to do equal, and then I'm going to calculate the first part. Okay. So I'm going to plug WD. So where do I click? I want to get WD. I'm going to click on C9. Okay. And I'm going to use multiplication sign. And RD is 7% times parenthesis 1 minus tax rate is 19%. Okay. Tax rate is 19%. This is my first component. Okay. Let me calculate the second component. Second component is, so this is my first component. So this is my first component. So I'm going to block that. So we have one block. We have 3 sources of capital, right? Second source and it's brought 2 sources, debt and equity, but we have preferred stock on this company. All right, we have 3 sources, right? So let me put this one is this color. This one is, what did I use? This one, and this one is, all right. So let me calculate cost of preferred stock. Cost of preferred stock goes to percentage preferred stock times the cost of preferred stock. Okay. So right now I'm not going to use formula. I'm going to just use number without. So I'm going to use just a number, okay, with 4 decimal. Okay. Finally, cost of common stock equals to this. You multiply by the cost. And again, I'm not going to use. It's easier to do at the end like percentage. All right. 4 decimal. All right. So you can add all these numbers together, because you see we have this plus in each of these blocks, right? Because it's a weighted average. So you can do this plus this plus this. This is 9.07%. In other words, equal. So let me put this one down. Equal. So that number, but you format this time in percentage. You don't have to do this long, but I'm just showing you step by step. So this is the answer for this question. This is the answer, okay? 9.07%. That is the answer for this question. So let me solve this one, everything putting together, so you can skip this part. So I can do everything here. WD times RD times 1 minus tax rate plus WPS times RPS times, okay, plus WS times RS. Okay, again I got the same thing. And then I just put in percentage. This is the weighted average cost of capital. Any question? Is this difficult to calculate? You know, when you set up a problem like this, it's gonna be so easy. Concept, because you already know that. There is a cost to borrow money, cost per debt holder. If you are buying debt, you have to get yield to maturity. That's the cost of debt. If you are buying stock, a company's stock price, you can see from constant growth model that price of the stock equals to the dividend 1 divided by RS minus G. So from there, you know that whatever rate of return you require to get for a company's stock, that is actually cost for the company. The cost is indirectly embedded on that, because the price of the company's stock depends on the cost, right? If the cost of equity is very high, that means if a company is very, very risky, you can see this penny stock, right? Why some companies, they have stock price like in pennies? Why some companies, they have so big stock price? It's because several factors. The cash flow, which is the dividend or free cash flow, and growth rate and cost. So price of a stock is function of so many things. One of them is cost of equity. So if the cost of equity is too high, nobody is willing to pay too much. Therefore, the cost of equity is indirectly embedded in the stock price. So you might ask me, oh, how does company pay cost of equity? This is how they're going to pay. It is in the price structure. The price of the company's stock actually is based on the cost of the equity, based on the risk. You can see when you use CAPM, higher the beta, higher the cost of equity. So cost of equity, you cannot see directly. It is embedded in the stock price itself. Therefore, we need to understand that way, okay? Cost of equity is actually not the return company guarantee to pay to the stockholder. The price structure includes that cost of equity. Question? Okay. All right. How about we do the second problem with the dollar amount? Okay. So let me copy that question. First, let me put this one, example 1. And so let me put everything I'm going to copy, okay? I'm going to copy every single thing we have here. then I'm gonna put it down right here, and I'm gonna come down a little bit down here. All right, so from my Word document, I'm gonna copy this other question. All right, so here you go. You see, it's the same question, but this time we have to calculate all of these components. Okay, I'm going to start with the scratch. So this is the model I already developed, right? So in this question versus this question, we have all this debt WD information, right? WD, WPS, RWS, everything is given. But in this second question, we have to actually estimate all of those things. So here, let me put down clear way, okay? I'm gonna summarize right here. Capital structure. So in capital structure, it has debt, preferred stock, and common stocks. All right, so this is in million, okay? Dollar in million. So how much debt we have? Somebody please volunteer. How much is the debt this company has? 40 million. How much preferred stock? 10 million. Thank you. And how much common stock? 50. Good. I made this number like easy to see, because earlier we had percentage. So let me put this one, and then I'm gonna do the total value. Okay, total value, right? So this is the total value. You know that in balance sheet we have assets equals to liability plus, so assets equals to liability plus equity. You know that, right? Each of you, all of you, in our from accounting 101, in balance sheet, asset sides equals to the liability plus equity, right? So here I don't have the asset side, but pretty much this is the total value of the company. We are only looking the debt and equity. We are only looking at the liability and equity side of the balance sheet. Clear? So this is the total value of the company. Okay, so this is the total value of the company. The company is comprised of debt, preferred stock, and common stocks. Okay, so we're gonna do sum total, and that's gonna give us the total value of the company. How much is that? $100 million. Okay, now here we're gonna calculate the weights, the percentage, or weights. Let me put just weight. Okay, so weight and percentage the same thing. Okay, that's the same thing, percent or weight. So how do I calculate debt? What percent debt the company has? How do I calculate that? Anybody can help me? So how do I calculate this one? Thank you. So you divide debt by the total value of the company, right? Total value of all those three components. So here I'm going to put a dollar sign. Okay, do you know why I'm putting dollar sign? it's a 40%. You can put that number in decimal, or you can put percentage. That doesn't really matter. If you want to put in percentage, that's fine. You can put 2 decimal. All right. So this is the percentage debt. Okay. This is percentage equity. This and this. But we break down in preferred stock and common stock. I already put the dollar sign so that I can control this. I don't have to type this again. I can just bring it down. You see, I just bring it down. So if I control dollar sign, if I don't control that, dollar is gonna keep on going down. So I'm holding that total value constant, and I divide that by, so I divide the preferred stock by the total value. I get 10%. I get 50%. I just need to fix this one. So how do I do that? If I don't put dollar sign, I just put this one. This is what's gonna happen. If I put it down, it's gonna be like that, because you see it's gonna drop down. So to make it fixed, I just put a dollar sign on that. Clear? Everybody got this one? Okay. And if you add them together, actually that's gonna be 100%. So that's gonna be 100%. In this example I gave, like, it's easy example, 140 40 million, 10 million, 50 million, but it's the same thing. It could be 140 million, it could be 150 million. It's but the percentage, this is not going to be, let's say if you have let's say you have only 30, right? So the total value is 90, but percentage, this is always going to be 100% means 1. Okay, let's go to our original example. Now we calculate all these WD, WPS and WS. Here you can summarize right here. You can say WS, sorry, WD, WS, sorry, what I do here, WPS, WS. You can summarize and skip this part. Here you don't have to do it. Or once you do this, you can also fill these numbers. WD, WPS, WRS. Okay. Let's fill the debt. How much cost of debt we have? 7%. Tax rate is 19%. 19%. Cost of preferred stock is 8%. Cost of debt is, cost of equity is 12%. You see, this is how much easier once you develop the model and then summarize. You can use your templates, you can develop it, and then you can solve it. So one more time, I'm gonna solve this problem here. Okay, I just summarize everything. So I want to put everything on the formula. WD is 40% times RD is 7% times 1 minus tax rate 19% plus WPS times RPS plus WS times RS, cost of equity. That's gonna give you the weighted average cost of capital in decimal format. You just format that number to percentage. It is 9.07%. Okay. Question. Well, then I have a question for you. And any of you can answer my question, okay? What if we have no preferred stock? If we, let me remove this part. Okay. If we have no preferred stock, what do you do? How do you solve this problem? What is the answer?
Take that portion out of it. The equation.
Okay, so I'm going to take it out. I have to take out both, okay?
Yeah.
Yeah, so I'm just putting that equals to 0, for example, right? So if you have no preferred stock, the middle part is going to be 0, right? So that's so easy. You don't have to be confused. This is the whole equation. This is the whole equation. And it's going to be always this and this. The last and the first part you're going to have on the equation. But the middle part, some company, they don't have preferred stock. Okay, preferred stock, I already explained you in your previous class. It's basically a hybrid security. It has the characteristics of bond and the common equity. It has characteristics of, it's like a hybrid security because it promised to pay the fixed dividend, right? Because it's a negotiated contract between the investors and the company. So Warren Buffett in 2008, he invested $5 billion in Goldman Sachs in returns for, I think there was, I don't know, remember the actual conditions, but the condition was, I think, 5% dividend, annual dividend, plus they were paying maybe $135 per stock price. So the price is fixed, the dividend is fixed. So in that sense, it's like a debt. But if the company bankrupts, then Warren Buffett would lose everything. Okay, so that's the characteristics of the common stock. So when a preferred stock is issued, actually it has the both component. It promised to pay the dividend, okay, and they cannot pay dividend to common stockholder until they can clear out the preferred stock dividend. But in case the company bankrupts, the investor will not get whatever promised amount. Everything is gone like a common stock. Okay, so that is the characteristics of preferred stock. So here you could have the whole thing. If a company has all these three components versus if the company doesn't have it, you just put that equals to 0. You can again over and over you can use the same structure. You can copy and paste this one. What if, I mean, I'm just showing you, what if you are asked to calculate only after tax cost of debt? If you are asked to calculate after tax cost of debt, you are calculating only R sub D times 1 minus tax rate. Look at that. How easily you can do that. So what I'm going to do, I'm going to put this one 0, this one 0, and this one 0. Okay. I'm going to put all this one equals to 0. So what happened here is gone, right? Then I'm going to remove that WD. I'm going to remove that WD because if you multiply with 0, it's not going to work, right? So it's a 5.6%, 6-7%. That is after tax cost of debt. The same template you can use for several things. All you need to do is just know what you need to do. This is after tax cost update. After tax cost update is only this part. Okay, well, any question? All right, let me go back to the original one, okay, so that we have the complete solution. All right, so I think everything is good now. And let me save, and I'm gonna share this file with you. I'm gonna go to week 3 resources and activities, and I'm gonna put a Zoom recordings, and I'm gonna post the Zoom video, and then this file. And but guess what? From last week, I checked. So actually, I created a YouTube channel because it's very hard to. If I do in Canvas, what happens is you have to download every single time. You know, it's sometimes maybe you cannot even download. So that's the reason I created another new YouTube channel and then posted the video. And guess what? I'm the only person I'm checking that. I get emails. So I think right now the view is 6. So that's the only me. I'm just checking because over there I can. If you have any question, you can type your question. Then I can respond to that, right? So that's the reason I'm thinking that maybe that's going to be a lot easier because people like more interaction. But guess what? I'm the only person I'm doing that. I sent email, I sent link, but it's not working. And but I get email. I'm lost with this class, and then I check in Canvas the statistics. How many times you view? How many times you log into the Canvas? How many times? And I can see everything. And I check whenever I get the email. I check how many times this person came to the class, and I say, oh, it was September 2nd. So September 2nd, the person was there. And then the day I had a question, September 16th. And how can you see the resources? I mean, you have to go to the course, right? Even I'm teaching on ground, I like to use technology. As you remember, when I was teaching BA 360, everything was online, right? You didn't have to give me the paper things. And this is technical age. I mean, we should use the technology to do things quicker, to record, so that we can go back and check. Anyway, so I'm gonna put that in module 3, and if you go resources and activity, that's where everything you can find. And I'm gonna post that over there. So this is actually question number 2. Let me correct that. All right, now I'm ready for your questions.
Number 12 on the cost of capital practice problem that you gave us in the resources.
Okay.
Specifically, how you're getting not the weights but the values for debt, preferred stock, and common equity.
Okay.
Those values, how you're drawing that from the information provided.
All right, I'm gonna be. So let me share that file. So this is my practice problem. Can you see this one? Yeah, so you are referring to that number 12, right?
Yes.
All right, I think this is the same thing. I have the video, right? I mean, probably it's a little bit different, but it's the same question. That's a actually very good question. I'm glad you went over this one. So basically, let me remove this one so that it can record better. All right, thank you for this question. This is actually a really, really good question. And this is a company. I created a small company. So this company has cost of equity 15%. Before tax cost update is 10.75%. Cost of preferred stock is 9%. Oh, sorry. Yeah, yes, sorry. Yeah, okay. All right. One more time. I created a simple company and include everything right here. Okay. So, and then I ask you, what is the cost of debt? What is after tax cost of debt? What is cost of preferred stock? Calculate cost of equity using the dividend discount model. So, and then I ask you, if you are considering to issue new equity, what is going to be your cost of equity. If you use CAPM approach, what is the cost of capital? What is the cost of equity? And put them together. So weighted average cost of capital. All right. So to solve this one, this whole question, I can go different approach. I can just go to cost of debt calculation, the cost of before tax cost of debt calculation, right? I can go to, or I can just start from this information. In this one, what I did was, I just summarize all the information. And I'm going to explain you. So in that question, the debt the company paid $1.70 is expected to pay $1.75 dividend. And if you see here, this company is expected to pay $1.75 dividend, which is D1. And the price of the stock is $34. The dividend is expected to grow 7%. There are 45,000 shares outstanding, 45,000 or million. Let me see here. This one has, okay, 45,000 shares outstanding. So I summarize this information, and then I also have beta. I also have price of the preferred stock. I also have the dividend for the preferred stock, number of preferred stocks. It's a market risk premium.
Jump in with a quick question.
So
on the, I'm stuck on the seventh problem on the homework, and it's a little more involved in this one. When we're doing that long-term debt, am I calculating the present value of all that long-term debt?
Exactly.
And then that's the total weight of long-term debt is the present value of all those bonds?
Yes.
Okay.
That's the based on the, because that is the based on the market price. Okay. If we go down here, if you go down here, right? So you have the tax rate, and it has the flotation cost of the equity, and then debt. In this case, what happens was, so this one is the book value of the debt. This value is book value of the preferred stock. This is the book value of the common stock. Okay, this is the total value. So as you can see here, 10, this one is 1.1 million bond. This one is, so this one raised long-term debt, right? So debt. So all this information is given, but you are not given cost of debt, but you are given the information. You are given the information. So, oh, but here the weight is given, but the weight you have to calculate using this information, right? So weight, you have to calculate the weights using this information. But look at here, I think I forgot to summarize the debt information. Here, to calculate your cost of debt, you have to find out YTM on your Excel. Okay, so here I gave all the information. I should have summarized this debt information. It's actually, you need to solve this one. What I did was this one. Let me, so in Excel, here I use equal rate function, and then I provide all the information, and I get this 9.57%, which is not given the question, and rest of them are, this is the CAPM approach. Okay, this is the dividend discount model. So you have even flotation cost in this case. If you have flotation cost, you just take out from price. So probably, so maybe you are referring to homework problem, then maybe it's better to look the homework problem. Can you see the screen?
Yes.
All right, that's good. So in this question, you are given this balance sheet, and let's see, and then you have long-term debt, it consists of this bond. So actually this one is the book value. This everything you can see over here is the book value of this company, right?
So it's book value, we're finding the market value, right?
Yeah, so but for market value, you are given the debt information over here, preferred stock information right here, and then you have common stock information right here. And in that problem, I have done like dividend discount model and then other model, right? Like CAPM. So the CAPM information here, and the vice president. Okay, let's see what happens. So over here, there's a bond and gives. So given the yields 11.8%. The responses, that is the risk premium. Okay, so this is the another approach to calculate the cost of equity. That is a risk premium on the bond plus that whatever guess value. Okay, and then the tax rate. All right, now. So you assume that you recently had someone to work on this one here. What are the current market value weights? Okay, so in this question, you are actually calculating the cost of, you are calculating the market value of debt, market value of preferred stock, and market value of common stock.
Yeah.
Right?
Yes.
All right. So, what is the best way to do this one? Let me see. So debt here.
Where I'm having some problem is that since it's not letting you put in the value to check if your value is right, if any one of them is wrong, they're all going to be wrong because you need to have the correct value to get the correct rates. And we kind of take the debt and check, oh, is that right? Oh, this preferred stock one is wrong. Just if one's wrong, they're all wrong.
Okay. So here we are calculating the value of the debt. The equity. So let's do 5 keys. NPER rate, which is YTM, PV, PMT, future value, and then here we do T, and then we do rate, and then here we do compounding. Okay, so this one has 30 years, right? And what is the coupon rate? Coupon rate is 7.6%. 7.6%. And what is the compounding? It's twice semi-annual, right? Okay, based on that. Okay, yeah, you can just plug your numbers. So I'm doing exactly the same question. You have a number one, but I have different numbers because it's a dynamic, right? Okay, so since this semi-annual, so what we are trying to do here is calculating the bond price. First, bond. Okay, market value of bond. That's what we are trying to do. So what is our number of periods? T times, so in this case we have 60 in my case, right? So what is yield to maturity? So 11 point, okay, so I have to do this one. YTM is 11.8%, right? So my yield to maturity is gonna be, that equals, I'm gonna divide that by compounding, right? So you can put percentage. And then this one says, I mean, we need to find out the value of this debt instrument. And the PMT equals to, let me put face value first. The face value is $1,000. Okay. And PMT equals to face value times the coupon rate, you divide by the compound. So that's your coupon payment. Okay. So our goal is to find out the value of the bond. So let me put a little bit nicer way. All right. So here I have this equals PV, okay, and NPER, sorry, NPER, oh, I'm not following, rate, NPER, PMT, and future value. So what is the price of the bond? This is the price of the bond, but what is our objective? Our
Just gonna multiply it. Yeah.
Yeah, so equals to bonds times one price, right? So that equals to, I'm gonna put debt, okay? So equals to, so in this question we have 29,412, right? 29,412 times this number, but it has negative, so I'm going to put a negative sign to remove that negative signs. This number. So this is my total debt, right? Let me see. Now. So I found the total debt. So we found the total debt. Now let's find out preferred stock and common stock. Common stock. Okay. If you go back to the question, right? If you go back to the question, let me share that information. So new share, and if we go back to the question in Mind tab, so let's get the preferred stock information, okay? So this information, let me copy everything from here.
Pretty weird if you tried to copy it all over because of the numbering.
Okay,
I had to do it one at a time.
no problem. Let me try one more time, okay, and see what happens. Let me put down maybe content and then share and screen. All right, can you see this one? Actually, I copied everything one time, and it's a little bit bigger, but I can see.
Yeah.
Okay, so basically we have this one is let's see, this one is first question, right? A, and then this one is B, and then so preferred stock. So preferred stock, this one has par value, pays quarterly dividend of 2, and the yield to investor is 8%, and new preferred stock would have to be provided same yield, and company would incur flotation cost. All right, so this is the second, because to find out the value of the preferred stock, we need to compute the, oh my, computer is getting slow. All right, so all right, so we are finding the cost of the preferred stock. So given the information, so P0, right? So PS, which is price of the preferred stock, that equals to dividend preferred stock you divide by the rate. Okay, so if you look at the question, in the question we have DPS, that equals to how much? If you look on the question, that question gives us the information that is $2, it's quarterly. Okay, and then we have 8%. All right, so that is 2, and then we multiply that 2 times 4, which gives quarterly $8, and then the rate RPS is how much in the question? It's 8%, right? 8%. All right, so this is RPS. All right, I'm going to calculate that. So DPS is $8. You divide by the rate. That's going to give us the price of the stock is $100. Okay, so that is going to be $100. Now, how many preferred stock the company has? How many preferred stock the company has? Okay, I'll check mine. Okay, so in mine it says how many preferred stock it has. Let's see, 50,000. Okay, all right, thank you. So the 50,000 preferred stock, and also I'm going to put so here. Preferred stock value equals to that price times 50,000, right? So 5 million is the preferred stock. Finally, So you remember, we have three components, right? We have three components: debt, preferred stock, and common stock. So let me bring this common stock information. So this is the preferred stock, and this is the common stock. Let's say this is company has this many shares outstanding, and the price is $20. Dividend is $1. So dividend per share is $1. Earning per share is $5. Okay. Return on equity is 10%. Okay. So basically what is happening over here is, let me see here. This one is cost of preferred stock. So we have debt, and then so I start the debt information, and so here we are considering the current market price. This question gives a lot of extra information. Yeah, so this. Alright, cost of preferred stock. And then common stock. So the common stock, actually here is the information is given. So a lot of extra information. Common stock. So basically the value of common stock equals to how many shares outstanding in the question. Yeah, in your case is 3.2 million. In my case is 3.8 million times $20, right? So 3.8 million, 3.8 million, 3 zeros and 3 zeros times $20. So I'm going to put, let me put that $3.8 million. 3.38 1, 2, 3, 4, 5, 6. I think that's 3.8 million. Oh, we need one more zero. No, it should be. 3.8 million times $20, right? 3.8 million times $20. So that's $76 million. Now let me bring down this one, easy for me. All right, so let's summarize that number. How much debt we have? 19 million debt. We have preferred stock equals to how much we calculated? 5 million. And then we have common stock equals to $76 million. Okay. So what we got over here? Let's see. This one is sentence. this one is F4, then put dollar sign here. All right, did you see what I did? I just estimate the bond value and then multiply with the number of bonds. So I got the bond price, so total value of the bond, and I found out the price of the preferred stock. You multiply by the number of shares. I got the preferred stocks value. Common stocks, I have 3.8 million shares and $20 each, so I got the value of that. Okay, so if you want to put dollar sign, and now this is the total value of the company, and I just divide each of these components by this this total value of the company. So let me put that information. Okay, so did you get the same thing?
I'm coordinating right now. My numbers are a little bit different, but I was having trouble. It was really just that there's so much extra information, and I wasn't sure if I was supposed to use some stuff. You know, as you understand, it's pretty simple, but it's just like the extra information is boggling me down.
That's right. That's definitely not in million. So it says the instruction: do your work in dollars, not in million, right? And all this extra information, definitely, you know, that's gonna make it more difficult to, because here, you know, what you need to do is just get the information. You are calculating the stock price. I mean, you are calculating all of this using the market information. But even though market information is that, but the information is like the second question, right? So flotation cost. This you don't have to consider the flotation cost, because if you issue right now, that's going to be your flotation cost. The third one, it just gives extra information, but all you need to see is the number of shares outstanding times the price of the stock, right? So did you get the correct answers for each of them?
Yeah, my work is wrong.
Okay, so I think this is the one. Yeah, absolutely, I understand that there is a lot of extra information. This is more like application of this cost of capital calculation question, the last question. So, but you know, I sent you an email last time. Did you see? You can check back the work step by step. So if it is the most difficult question and you are not able to solve, you can go back and check it.
All right, they were all wrong. So it was hard to know specifically where I was going wrong. I was just going wrong with the calculating for the thought. But since all the weights at once, if one of the numbers is wrong,
That's right.
I couldn't tell.
Do you know you can check your work? Let me put down that. Okay, let me share the screen. Now this one is right. So after tax cost update. So what is after tax cost update in this question? I have cost update is, we have 11.8%, right? And then what is the tax rate? 25%. So basically, let me see so 11.8% times 1 minus 25%, that's gonna give you the answer for this one, right? What is cost of preferred stock? What is cost of common stock? This question here, you have this, let me put here, draw. This one is actually using CAPM. According to CAPM, this is RS equals to RF plus beta RM minus RF. Okay, so if you look at this, so here you have kappa macros. So the beta is 1.6, T-bond has 7%, and RPM, which is basically RM minus RF. So basically you have, and you should have a risk-free rate. Okay, so what is the risk-free rate? Treasury bond 7%. 7% plus beta is 1.6 times 5%. That's gonna give the answer for that. For this question number D. And question number E. So if you use the retention growth equation, yeah. So please check this one. There is an example using retention rate, like cost equity information, and just plug the number. And this one is bond yield plus judgmental risk premium. If you look that information here, the bond yield is 11.4%, and then this premium is 4%. So 11.8% plus 4% is how much? 15.98%. Yeah, 15.8% over there. So 11.8%. So basically, rest of the calculation. So this takes a little bit calculation, and then this question takes a little bit calculation, and rest of them are the and then last one you have to combine everything. Okay.
Yeah.
Is this helpful? No. Okay. This is the formula for CAPM. Okay. Okay. Let me put this one. Draw in, and actually, so here, let me put down. This is I want to see the actual terms they use, because you can call RPM, or you can call the way they. So here you can see the CAPM one here I'm looking. So this one is the second part, and this one RPM. Okay, the RPM is actually risk premium on the market. So when you do this one, this is a risk premium on market. Okay, this is the whole thing, risk premium. So RF is 7% times beta is, how much is the beta? 1.6 times 5%, right? All right. So guys, I hope this helps you. I'm gonna post the video, and let me conclude the formal session here today. And then if you have any other question, I can answer informally. So this is the end of the June session I have today on September 17, 2020. And I'm gonna post the video in Canvas. So please check your Canvas site. And one more time, I'm showing you how to check your Canvas site. Okay, let me share the screen again. And in Canvas, what you can do is you can go here in Canvas, and you go to the modules 3, and here is the module 3, and resources and activities. And if you click on resources and activities, I'm gonna post this information somewhere here. Okay, maybe just before the practice problem. So Zoom recordings I'm gonna post over here, I'm gonna just clean the video a little bit and then post it here. Hope that Zoom recording is gonna help you a lot. Thank you.